Taxes are difficult to navigate, especially when you are not residing in a country and may not be aware of all the details and requirements. US definitely comes to mind when I'm talking about difficult tax systems. So today I'm going to tell you how to avoid the US tax trap. My name is Rusudan. I'm responsible for financial health of Nomad Capitalist, where we help high net worth individuals legally reduce their taxes, get second citizenship, and go where you're treated best. The United States follows a US citizenship-based tax model and not a residence-based tax model when it comes to individuals. Technically, it's referred to as a citizenship-based taxation, but it is more accurately defined as US person-based taxation because lawful permanent residents and foreign nationals who meet the substantial present test also can be subject to the worldwide income tax regime. This essentially means that if you're moving out of the US or moving to the US, you may be subject to income tax and required to file certain forms if you meet a few criteria, and those may not always be clear and easy to see. There are a few key points you need to consider when analyzing this situation, one of which is a substantial presence test. According to the US law, you will be considered a United States resident for tax purposes if you meet the substantial presence test for the calendar year. To meet this test, you must be physically present in the United States on at least 31 days during the current calendar year and 183 days during the 3-year period that includes the current calendar year and the 2 years immediately before that. So all the days you were present in the current year, 1/3 of the days you were present in the year before, and 1/6 of the days that you were present in the second year before the current year. For example, let's say you were physically present in the US on 120 days in each of the years 2020, 2021, and 2022. To determine if you meet the substantial presence test for 2022, you count the full 120 days in 2022, 40 days in 2021, 1/3, and 20 days in 2020, that's 1/6 of 120. So, since the total for the 3-year period is 180 days, you are not considered a resident under the substantial presence test for 2022. The solution here is pretty simple. Keep track of your physical presence and keep it under 183 days. Another key point is the US situs. So US situs assets generally include real and tangible personal property located in the US, business assets located in the US, and stock of US corporations. The definition of the US situs assets may be modified by an applicable estate and gift tax treaty. At the moment, estate and gift tax treaties currently range from 18% to 40%. This means that if you own any of the assets, you are subject to US tax. US assets can be real estate and US corporate stocks, US partnerships, land. The US situs assets include any stock in corporations, whether it's private or publicly traded companies like Apple and Google. Also, a private loan from a US person or a company counts as well. Treasury bills, bonds, and government securities do not fall into this category. One solution to avoid this trap is to set up a foreign trust for US situs assets. With a trust, you can get asset protection and succession planning. If you have a lot of descendants, you will manage easier who gets the money and when. Trusts are better in mitigating any litigation risks. In a trust, you are essentially giving up the control, so it is tougher for people to sue you and get your assets. Trust is for people with more complicated situations and more factors involved, people with problems with litigation and estate planning and inheritance planning. But if someone just wants to avoid US estate tax, a foreign company will do just fine. You also need to think about US source income, FDAP, and ECI. Let's go through them one by one. When a person is a non-resident alien, they are still subject to the US tax on income that is sourced in the United States, unless there's an exception. An example of an exception is US capital gains. So a taxpayer who is a non-resident alien typically does not have to pay US tax on their US capital gains, while dividends are still taxable. FDAP income, the same as passive income like rent, refers to fixed, determinable, annual, and periodic income. Essentially, FDAP refers to passive income. With this type of income category, non-resident aliens may be subject to 30% withholding tax, which is significant, especially if the non-resident alien would otherwise escape tax in their home country or country of residence on this income. If a person is subject to FDAP withholding, they will want to evaluate any particular tax treaties that may be applicable to see if they can reduce or overall eliminate withholding tax. ECI refers to effectively connected income, which essentially means any income associated with the U.S. trade or business. Unlike FDAP, taxpayers can take deductions with ECI. For example, if you're a taxpayer, you can elect to treat rental income as ECI, and that means that you can take deductions like commissions, maintenance, depreciation with this income. With this category of income, taxpayers are taxed at the same progressive tax rate as their U.S. resident counterparts. Despite the fact that the general baseline rule is that non-residents are taxed on FDAP and ECI subject to 30% withholding rate, there are some exceptions, exclusions, and limitations to consider. From our experience here at Nomad Capitalist, we recommend reviewing your tax situation thoroughly and planning accordingly. For more information, you can go to nomadcapitalist.com or leave your comments below.